Let me quickly focus in on the couple of managements we have on the show today. First off, PNB Housing Finance. We have Girish Kousgi, who's the MD and CEO at PNB Housing Finance, who's joining us. And Q4 numbers, of course, but what's in store for Q5, and can growth really come back will be the big question. Now, firstly, welcome to the show, Mr. Kousgi. It's a pleasure having you on NDTV Profit.
Good morning. Good morning, Harsh.
Sir, let me first start off with margins. Roughly 3.5% is what you've guided for. 3.65% is what you've done for Q4 at least. Any upside positive possibility on margins given your rating upgrade? That's one. The second piece is also, as capital gets more and more optimized within the organization, is there a possibility that you could possibly beat that 3.5% guidance that you've given for FY25?
I think we should look at 3-4 parameters before talking about NIM. So if you look at last 4 quarters, we started affordable housing, and now we have built a book of about 1,800 crores. So that will now start getting us better yields. We got rating upgrade, so that will ensure that going forward in next few quarters, the cost of borrowings will come down. We also drew about 3,000 crores from NHB, which comes at a lower cost. So having said all of these things, NIM guidance for FY25 is going to be at 3.5%. There'll be a little upside on the fee. In terms of credit cost, it will be muted. For FY24, we had guided 60 bips. We ended FY24 with 25 bips. So the guidance for FY25 on credit cost is going to be about 30 bips. And we have a large pool of about 2,000 crores, which we have written off, and there is a recovery possible from that pool. So if you consider overall, I think little bit of compression on the NIM would be compensated by some of these things.
Okay, so sure, point taken, and I'll come to each of those. I'll try and break those up. First off, with regard to growth itself, could a mid-teens or closer to 20% growth be a possibility at all for FY25?
So if you look at last year, for the first time, we have grown the retail book at 14%, which is the highest in last 4 years. If you look at overall growth, we have grown at about little over 10%, which is the highest in last 5 years. Why I'm saying this is that we are degrowing a corporate book. Last March, a corporate book was 4,000 crores. This March, it's approximately about 2,000 crores. So the corporate book is depleting. Retail is growing, and therefore you will see that the overall book growth is at 10% and retail at 14%. Talking about FY25, on the retail side, we plan to grow at about 17% on book and 25% on disbursement. Why 17%? Because we are moving towards high yield segments. Our focus now is largely on retail. If you look at the overall portfolio, 97% is retail and 3% is corporate. Within retail, we have 3 verticals. Prime, affordable, we started about 15 months back. And this year, we started emerging vertical. So emerging verticals and affordable constitutes to almost, in terms of branches, 2/3, which is 210 branches. These 210 branches would focus on high-end business. And therefore, we want to grow the book. The book has to be profitable. And therefore, the growth rate is 17% and disbursement is 25%. Sometime during the year, we will start corporate in a small way.
Sure. Okay, so sometime during the year, you'll go back to corporate as well. 2 risks possibly, or some apprehension possibly in investors' minds. One, as you start to grow corporate again in FY25, what are the safeguards, what are the guardrails you'll put in place? That's one, and what's the kind of comfort you have on that? And second is with regard to your emerging businesses as well. What's the kind of comfort, given that they'll be slightly higher yielding? So my guess is there'll be slightly higher risk, or do you feel that risk may be controlled there?
I think first on corporate, I think we will stick to basics. And corporate is a business, which this industry has seen over last 3 to 4 decades time. So we had got certain things wrong in the earlier avatar. So this time we will take care of all of those things, and we will keep it very specific and stick to basics. we would focus on slightly lower ticket size, on very good set of builders, Cat A and Cat B, project specific. We would be only into construction finance, not into any other kind of corporate lending. So I think we will have our framework ready and we are pretty much comfortable. So we plan to start that this year. Now, in terms of prime and emerging, I think not much of difference in terms of the risk. There is slightly incrementally, the risk is higher in the emerging compared to prime, but not very different. Even on affordable, I think we have a good experience in last 15 months. But even otherwise, in some form or the other, I think the entire team is from affordable industry. And even I've been seeing this industry very closely since last 15 years. So the risk is higher. So if you talk about credit cost for a prime kind of business, the credit cost is going to be for a well-managed company, anywhere between 20 to 24 bips. For emerging, it's going to be about maybe 30 bips. And for affordable kind of company, it's going to be about 50 to 60 bips. So since the yield is high and we will have better margins, I think these risks are very easily manageable.
Sure, got your point. I want to first off talk about recoveries before we move on. On the Q4 as well as the FY24 recovery number, could you give us that number?
So in the whole year, we have recovered about 100 crores. So we have a large pool of 2,000 crores. So we would have good recovery in FY25 as well. So this entire written off pool would play out in terms of recovery in next 4 to 6 quarters time.
Okay, so out of the 2,200 crore odd pool on the recovery front, on the retail, you have 500, 1,700 on wholesale, if I'm not wrong. What's the kind of recovery visibility, FY25 and 26, if I can just try and pull both those years together? Or maybe only FY25 first and then 26?
I would not be in a position to give you any numbers on that, especially on the corporate side, because, if you look at last year, our GNPA was almost about 23%. And if you look at this March, it's about just 3%. We have one small account. And we also have resolved, a lot of accounts, which were written off. So on the corporate side, we would definitely have some recoveries. On the retail side, it will be more consistent. We can see that benefit coming quarter on quarter.
Okay, understood. And with regard to ROAs, therefore, what's the sense if we leave out recoveries? Would ROAs be stable between 2.2% odd, or what should the ROA band be?
ROA, I think leaving recovery should be about 2+, and the upside what we get from recovery will be an addition.
Okay, and with regard to credit cost guidance, 30 bips, my guess is that excludes the recovery possibilities that you've kept open for FY25?
Yeah, 30 bips excludes recoveries.
Sure, understood. Okay, 17 to 19%, 17% growth is the guidance number. New businesses, etc., also coming in, 30 bips of credit cost. Thank you so much, Mr. Kousgi. It's a pleasure speaking with you, and thank you for all of that perspective and guidance. Some bit of recovery is also to come in FY25, non-committal on that number, but keep your eye out. PNB Housing, a very interesting play. Let's quickly pull up the stock itself. Was buzzing at least early on in trade. The sense is it is continuing to buzz in trade as we speak. Good one, good set of numbers overall from PNB. We'll slip into a very, very short break. More on the other side. We have a special conversation with Zensar Tech's management lined